Welcome, everybody, to another monthly webinar on financial planning, your favorite topic and mine. This month, we're talking about what to do with your old 401ks. And this will be about a 20-minute webinar. And then I'll stay on as long as you want me to answer questions. So if you already have questions, go ahead and put them into either the chat or the Q&A, and I'll get to them. But 20 minutes of material and then Q&A. And at the end of the 20 minutes, I'm going to give you an offer for a free session to talk about any financial planning topic. We could talk about your old 401ks or anything else, absolutely free. That's a $300 value just because you attended today. So let's get started. So who am I? My name is Joe Morgan. I'm a CFA and a CFP, and I provide financial planning for people who have variable income, mostly people who have income from stock, and they're trying to integrate it into their financial life in the best way possible from both a tax and a market perspective. For 25 years, I was managing institutional money. Most recently, before doing this, I was chief investment officer at Silicon Valley Bank. So I was managing the money that a lot of tech firms had accumulated through venture fundings and, well, just profits as well. For the last 5 years, I've been working with families to help them in their own personal finances. Now, what we're talking about today is not financial advice. Financial advice is specific to you and your situation. There's all kinds of products, all kinds of strategies, all kinds of things you could do out there. They're pretty much all valid paths that you could take. What's right for you is going to be different than what's right for your neighbor. And that's what financial advice is all about. What we're talking about today are simply general concepts and what I like to call money moves that may or may not be appropriate for you. So we're just sort of introducing the topic. And you can see there at the bottom a list of my previous webinars. I have all those recorded and happy to share if you want to reach out to me. So what is financial planning? Here's how what we're talking about today fits into financial planning. So there's 4 areas of your financial life here, these 4 columns. First, protect what you have. That's insurance and estate planning and all that fun stuff. Know where it goes. That's spending. That's super, super important that we know what our spending is. A lot of people interpret that to mean that we reduce it. Well, I don't know if you have to reduce it, but you have to know what it is, just like you know how much money you make. And just like you know how much money you have, you should know how much you spend. The third area is making it grow. That's investments. That's where we're focused today. And then the 4th area I call retaining independence and dignity. It just means we're not going to live off our kids in our older age. We're going to understand how our decisions today affect us in our 60s, 70s, and 80s. We approach all of this with intention and purposeful effort. And we're trying to build your best financial life, not the best financial life of everybody who lives on your block, but the best financial life for you, the one that's right for you. Here's where what we're talking about fits into the process that I go through with clients. So I have investments way down here. Most people think finances is all about investments. It's not. Investments are super important, but they're not the only thing, and they're not even really the main thing. They're a supporting player in your financial life. And I say that because we can't control them. All we can do is set up for the type of risk we expect and the type of return we expect. But once we set it up, we have no control over what the markets are going to do. And so we've got to be able to move other pieces of the board around that to make sure we're successful no matter what the markets do. So very important what we're talking about, but not number one. Okay, here's the problem most people have, what I see with old 401ks. Too many accounts and no overall strategy. I'm going to talk about this a little bit later, but we want our investment strategy to come from the top down. It shouldn't matter if our money's in a Roth or an IRA or 401k. It should all be working together to get us where we want to go. So we need to have an overall strategy, and that's really hard to execute when we have too many accounts. We just can't keep up with all that stuff. So your money is far too important to leave to chance. So let's talk a little bit about what is a 401k or a 403b or other retirement plans. So we're talking about defined contribution plans. So there's defined contribution plans and defined benefit plans. A defined benefit plan is a pension where you work a number of years and then they send you a check every month until you die. That's not what we're talking about. We're talking about a contribution plan where you work a number of years, and while you're working, you put money into the plan, you control the investments, and then you get to decide how much to take out and when later on. These are funds that you own, at least the vested portion, which most of it is going to be vested. You actually own those funds, and there's a tax advantage, but in exchange for that tax advantage, there's a penalty if you withdraw the funds before age 59 and a half. So there really are retirement funds. We want to put money in there. We want them to grow and use them in retirement. Now, there's two different types of accounts we can have from a tax perspective. There's traditional and there's Roth. Traditional plans offer you a tax deduction on the day you put money into the account. So if you put $100 in this paycheck, you get to deduct that $100 from your taxable income when you calculate your taxes at the end of the year. Now, if you take money out of the account, you're taxed on it. So you're not taxed on the way in, you're taxed on the way out. Okay, so you put money in, no taxes, it grows and grows and grows. You're taxed on that whole amount as you take it out. There are employer and employee contributions as well allowed in the traditional side. The Roth side, Roth is a little different. It's still a tax advantaged account. It's just tax advantaged in a different way. And here's how it works. You put in money and you don't get a tax deduction, okay? Then it grows and grows and grows, and you take it out and you don't pay taxes on it. You don't even pay taxes on the earnings. This is why a lot of people like Roth is it's one of the only ways where you can make money. In other words, you invest and that money grows, and that additional money that you make is never taxed. So the original part that you put in is taxed because you don't take the deduction, but the growth is never taxed. So people really are excited about that. But in order to get there, you've got to pay tax today on the money you put in. And if you're at a very high tax rate today, that may not be the best strategy. Like I said, depends on your situation. So put money in, it's after-tax contributions, meaning you paid tax on what was in there, it grows, and you take it out, there's no tax whatsoever, as long as you follow all the rules, take the money out after 59 and a half and all that stuff. And the other interesting thing is, for the Roth portion, they only allow employee contributions. So when your company puts money into your 401k, that has to go in the traditional side. It cannot go in the Roth side. So even if you have always put 100% of your contributions in Roth, all the money the company has put in is actually in traditional, and you will be taxed on that when you take it out, when you use it. Okay, what can I do with old 401ks? Well, there's really 4 options. And so here they are. First, you can take the money out. You can pay the tax and the penalty if there is one, and just take it out and use it in your regular life. Not typically the best choice, right? Because you've already got it in there. It's already tax deferred, and we want it to grow. But if you need the money, it's there for you after tax and after penalty. If you could also, number 2, you could leave the funds in there, but don't forget them. You see people with remembering years after, oh yeah, I think I've got an account over here. Don't do that. We don't want to do that. It's okay to leave them there, especially just, maybe for a little while, but you don't want to end up forgetting them, because that's your money and it would be totally lost. And it's hard to find forgotten money if you don't even know it exists. Number 3, you could roll them into your current 401k. So let me just step back and say, what does roll mean? Well, that's an industry term. It just means move. Just means that you can move them. So you can move them from their 401k from your old company to the 401k from your new company, assuming the new company allows that. Most of them do. That makes it a little bit easier to manage, gives you just the one account. But 401ks are not typically desirable for a reason. And that reason is they can be expensive, and the investment options are fairly limited. So that's an option. You could do that, especially if you just have a small balance, you don't want to mess with a separate account, perfectly fine. Number 4, you can roll them, again, move them into an IRA. So you don't have to already have an IRA. You can create an IRA with no balance in it and then move your old 401k in there. You could even move your old 401k from 4 or 5 different companies, 4 or 5 different old 401ks in there, and consolidate that way. And that'll make them, of course, easier to manage. Now, I want to focus on that option number 4 because that's typically the best way to go and most commonly. And but I want to talk about the pros and cons of that. So let's talk about the pros. I've already mentioned this one. You could do whatever you want with it. It's an IRA. It's just like an investment account you have. You can go buy any mutual fund that your brokerage allows. There's no fees in terms of an administration fee like there is in a 401k. And so you've got a lot of freedom there. And that's the main reason why I think people enjoy rolling money into an IRA. There's lower fees and the more investment options. There's also a little bit more flexibility with beneficiary options. If you have some complex estate planning, IRAs are easier to use, and of course easier to track and fewer accounts. So that's the main reason you can really, if you have a top-down strategy, like I mentioned before, and I'm going to talk about again a little bit later, you can more easily make that strategy work in an IRA because the world is open to you. You can buy anything you want. If you're in the 401k, you're typically limited to whatever funds they require you to use. And there's a reason they limit those funds. The reason they do that is because there's higher fees there, and that helps pay for the 401k itself. So you're paying higher fees and you're limited on investments typically in your 401k. All right, so that's the pros of rolling. Let's talk about the pros of keeping your 401k. And there are some. Number one, possible to not have a penalty for withdrawals after age 55. Now remember, I said 59 and a half, that's where the penalty starts. Well, there is a strategy where you could take money out at age 55 and not pay a penalty. You have to quit your job, basically be retired, and you have to sign up for substantially equal payments each year from age 55 to age 60. And so I think it's a 73T. I forget the exact phrase, but you can't just take out so much at age 55 and then take out a different amount at age 56. No, you got to make it structured. So most people try not to do that. It's a little bit restrictive, but it is possible. There's also a greater ability to convert post-tax IRA balances to Roth. In other words, to do backdoor conversions. And that's a deeper topic, but if you've heard of backdoor Roth conversions, that's where if you make too much money to put money in a Roth IRA today, you can actually put money in a traditional IRA and then convert it to Roth the same day or the next day. And that way, by that way, you can get money into a Roth even though you're over the income limit. However, if you have other IRAs, that muddies the water and can make it very expensive to do because the way the IRS looks at all of your IRAs at once, again, a little bit complex. But if you're one to do this backdoor Roth strategy, you probably don't want any other IRAs out there while you're doing it. The third benefit of keeping your old 401ks is stronger credit protection. You cannot be sued for your 401k balances. Now, you can be sued for your IRA balances, but in the state of California, only for amounts over $1 million. So if you have less than $1 million in your IRA, you still can't be sued for that. You can't lose it. But there is a little bit more protection in a 401k, meaning that it's unlimited. So I don't know, if you have a $4 million IRA, that could be important to you. You could also possibly take out a loan if the plan allows, even after leaving the employer, if the plan allows. You can never borrow against an IRA, okay? Hopefully we're not in a position that we need to borrow against our retirement accounts ever, but if you were, you can do it in a 401k, possibly. You cannot do it in an IRA. So there you go. Let's talk about the overall portfolio. I'd mentioned this. So it's very important that all of your investments are working together to get you where you want to go. In other words, you don't want to have a different strategy for each account because you're going to be duplicating the work that one account is doing with another. You may be duplicating fees, and it's just not going to be easy to understand overall where it's taking you. So when we put together an investment strategy, and I have a webinar on how to do this, it's called How to Build a Long-Term Portfolio. We start with just this pie chart right here, and not this particular one, but these ingredients, and say, okay, what's the right mix that we want to have? Then we go to the account level and say, okay, which account should own which strategies or which part of the mix. So we start from the top and go down. If you're the way the industry is structured is it encourages you to go bottom up, and that way can be very confusing and very difficult to put together a good strategy for you. All right, so you're convinced you want to combine your accounts, whether you're going to your current 401k or you're opening an IRA and combining there. How do you do it? Well, it's actually very easy for you to do, but it does take time. And so here's how it's very easy. Step number one, call the company where the money is going to. So for example, I like Vanguard. So if you're saying, I want to combine all my old 401ks and I want to put them in an IRA rollover at Vanguard, here's what you do. You call Vanguard, you tell them exactly that. They will give you the forms to open the IRA account. Then they'll give you the forms to transfer the funds. You won't ever even have to talk to your old 401k provider at all. If you have a financial advisor over there, you won't ever have to talk to that person either. All you have to do is work with the place where the funds are going, and they can pull the funds with your approval. Very easy process, but again, it's time-consuming, paperwork-driven, and you can imagine why, right? You don't want that to be an easy process. You don't want it to be easy for somebody to pull your retirement funds from your account. You want there to be some checks and balances there, and there certainly are. So, all right, some important tips here. If you have Roth and traditional IRAs, now not 401ks, because if you have 401ks, Roth 401k and traditional 401k, the 401k provider is going to keep all the accounting, all track of that. But if you have traditional and Roth IRAs, and especially if you have post-tax balances in traditional IRAs, you really need to keep good records of that, and you want your CPA to really understand all of those balances when they're doing your tax forms. It's up to you to get this right. The IRS is not going to check and balance and tick and tie this. So I've seen several instances where people have paid tax on a Roth IRA contribution and then paid tax again when they use that money because they forgot. So keep really good records on all of this and make sure your CPA is aware of that so they're filling out the tax forms correctly. This is another good reason and a good area for you not to be doing your own tax forms. If you can get a CPA to do your taxes for, depending on how complex it is, $800, $1,200, $1,500, could be well worth it, could save you a lot of money. Second tip, understand whether you have basis in your current IRAs. What's basis? Basis is that post-tax balance. So if you've put money into a traditional IRA and did not take the deduction, remember you have the right to take the deduction, but if you did not, that's a whole different animal. And you want to know that that's there. And again, you want your CPA to know that it's there so that you're doing the right things and you're getting the right tax effect for that. The third thing is I hear a lot of people talking about the 60-day rollover, one-time 60-day rollover. So what that is if you move money from an IRA to another IRA, you can actually get a check. The first IRA can write a check made out to you personally, and you can go to the bank and cash it. You could use that money, and as long as you get it into another IRA within 60 days, you're good. So it's like a 2-month loan that you can take. Very, very dangerous strategy though, because if you get it back, if it's day 61, the money goes back into the IRA because you mailed in a check and the postal service was a little late, too bad. They're going to treat it as a taxable withdrawal, and then they're going to treat it as a non-allowed contribution. You got penalties on that. You're going to get hit on both sides. Very, very dangerous strategy. I don't recommend it at all. So be very, very careful of that. Also, one of the things that the people who actually do this, one of the things they don't realize is you can only do that once in a 12-month period. It's not a calendar year. So you can't do it on December 31st and then do it again on January 1st. It's a 12-month period. And if you have CDs at a bank that are IRAs, this can really trip you up. So be very, very careful of that. Oh, look at that, 20 minutes, perfect, right on time. So, but what about you? So here's the deal. tomorrow you're going to get an email with a link to replay this webinar and a link to download the slides. Take a look at this, think about your situation, review your old retirement plans, and schedule a call with me. This is that free coaching session that I'm offering everybody who attended this this webinar. It's a $300 value. All you have to do is schedule time with me. And what I'm going to do actually right now is in the chat, I'm going to put the link to schedule time so you'll have it. Let's see if I can actually do this. Look at that. There's the link. You can use that to schedule time with me. Free coaching session, no cost, no sales pitch, I promise you. We're just going to talk about you and your situation and try to get you some help and solve whatever challenge it is that you're facing and go from there. Let's see here. Oh, disclosures. Oh, here we go. Resources. I do a podcast weekly, Deliberate Money Moves. You can find that wherever you listen to podcasts. I have a weekly blog as well, and videos where we're going through tips, financial tips every single week. They're all very, very short and very targeted, hopefully very helpful. So take a look at those, or if you're not on the list, let me know. You can send me an email here at this one right here, joe@bestfriendlife. Very important. Along with the email that you get, you're going to get a link to schedule for next month's webinar. Next month's webinar is What is Financial Planning? On September 9th. We're going to go through a top-down version of what it is, and I'm going to show you a cash flow strategy and what it actually looks like for somebody to use financial planning to make decisions. All right. Thank you so much.